that is to make sure you always have a very strong debt service coverage ratio. Anybody know how to do that?
Just what ratio?
Debt service coverage ratio. You understand that, right?
Yeah.
Okay. It's what I call $1.25 of income to $1 expense.
Right.
That's typically what a bank will do. But if you want to be safe, it could be $1.50 of income to $1 expense. It could be $2 of income versus $1 expense. That's the ratios you want. So that's one of the best ways to protect yourself. Because again, if you own the property free and clear and the market tanks,
Right.
it doesn't matter. What you're hedging yourself against is debt.
Right. That's
My gosh, how simple is this?
debt and like taxes.
Because think about it, I would pay $40 million for this deal if I can literally buy and make $100,000 of positive cash flow every single year. As long as I don't have to worry about any debt, right? So the reality is not even the price point that matters. What matters is that if the times go down and you do have to lower your rents or you experience some high vacancy, you're going to be able to pay your mortgage, right? So if you own it free and clear, what do you care? And really, that's why a lot of investors, that especially bigger funds, the way they hedge themselves, even though they call losses, the losses, what they're saying is, okay, our value of this building was $6 million, now it's $3 million. We've lost money. And that's, by the way, that's how banks are getting in trouble. Because banks are lending money, they loan it based on a certain loan-to-value ratio. Now that the property values came down, they by law have to now recalculate their numbers, which means they're backwards. So now they either need to get the money back from the actual tenant, or they need to have that money in reserves, which they can't use. That's the reason why this bank here went down. They didn't have it in reserves. So another bigger bank came and took them because their reserves were there. And they got those debts at a discount. I love this country. Isn't that amazing? So the reality, when you say, Rick, what is it? What you're saying is, Rick, how much am I willing to risk based on debt? Because here's the thing, and this is an amazing thing. I never really got it. I was talking to, because before I was kind of like you guys. I was just, oh man, this is awesome. I'm so excited. And I'm spending time with these old guys, my old buddies. And they're just laughing at this market. They're like, oh man, I hope it just lasts just 1.5 more years so we can buy 5 more properties. That's the way they see it. Like, oh man, I really hope Bank of America goes down so that we can take this property right here. That's really cool. Isn't that cool? You know what you're doing.
People who like Bank of
Yeah.
America to go down.
Oh yeah, absolutely. But the reason for that, if you look at, there's a hotel owner, I can't remember the guy's name. He's friends with one of our guys. He owns a ton of hotels in downtown Orlando. This market is pretty tough, wouldn't you agree?
Yes.
So, if you got a lot of debt, like most hotels who leverage, you're hurting. That's why a lot of them are going bankrupt. But notice that when they go bankrupt, most of them are rebuying them back. They're doing their own short sales. Hint. Anyway, so what was I saying? I just totally got lost. We were talking about, hotel. There we go, hotel guy. This guy is incredible. Now you can't really do this with the more luxury hotels he has, but he buys everything 50% equity, 50% debt if he uses it.
Wow.
Okay, now that's a very conservative approach. But here's the beautiful thing about it. There is a certain limit to most people that are in debt that they can lower their prices because then they can't pay the mortgage. So then what are you doing? So they have to experience vacancy. What this guy does is whenever he has any vacancy at all, especially on his lower hotels, he'll say, okay, so today, 9 o'clock in the morning, your rate is $89 a night. Noon today, $68 a night. You can go down midnight and get it for $15. What does he care? He just made $15 on an empty room. Yeah. And not to count the fact that in the morning when you wake up and you're hungry, you're going to pay for it. You're going to get a movie or whatever you're going to get. There's an extra opportunity for you to make income. So every time he's dominating the market while everybody else is vacant, they're full. Because people that can afford it now can move and stay there, and they're saving money. So it all depends on how much you have. So let me give you an example. The reason why we're so excited about this particular building itself is because if you really take a look at the numbers, okay, the average rate is $18 a square foot in a Class B office building. What if I told you that the very first year, I'm going to give you $12 a square foot? Get you excited, right? You're like, okay, I will come in. Now here's the deal. Year 2, $14 a square foot. Year 3, $16 a square foot. By the way, you have a 7-year contract.
Right.
You do the math. all of a sudden, you're escalating your income, but you're making money now on something that's going to be vacant. Only you can do it because the copper whopper's got debt. He can only go so low. That make sense?
Yeah.
Quest over here has got some debt. So Quest is not going to give you some discounts. Wachovia Bank has got the same thing. Fairwinds has the same thing because they all have some sort of debt. So they can only go as low as they go. But if we own this building free and clear, I can charge literally $10 a square foot and still make money. I can charge $4 a square foot and still make money. Do you see the difference? So do I even care? I'll be 100% occupied while everybody else is 20% vacant. Because I've lowered my prices to the place where I'm bringing all the tenants.